Ladies and gentlemen, good afternoon. I am pleased, in the name of Majid Batucci, the chairman of the Swiss Business Network Saudi Arabia, to welcome you to our webinar on dual taxation. Let me introduce the network established in 2016 under the patronage of the Swiss Embassy in Saudi Arabia, and its objectives are increase the business and cultural visibility of Switzerland in Saudi Arabia and promote Swissness in the Saudi media, support the members in carrying out their business activities in Saudi Arabia, facilitate dialogue among members and Swiss businesses and Swiss government or Saudi governmental and private market partners, keep members informed about economic, political and cultural development in Saudi Arabia, help new entrants into the Saudi Arabia gather the market information and become familiar with relevant rules and regulation. We have two types of members. We have individual and corporate members. On the next slides, you will see the list of our current corporate members. Today, our webinar program is as follows. We have the pleasure to have three experts as guest speakers, introduced by a welcome note from the Swiss Minister of Finance, Federal Councillor Ueli Maurer, followed by a Q&A session.
Sehr verehrte Damen und Herren, die Rechtssicherheit ist ein wichtiges Gut im Geschäftsbereich. Das zählt national, vor allem aber auch international. Die Schweiz widmet diesem Thema hohe Aufmerksamkeit. Ein wichtiges Element für Rechtssicherheit sind Doppelbesteuerungsabkommen. Die Schweiz hat über 100 davon. Unser neuestes Doppelbesteuerungsabkommen ist ein Abkommen mit Saudi-Arabien. Ich freue mich, dass dieses Abkommen zustande gekommen ist. Es unterstreicht die guten Beziehungen, die wir miteinander führen. Es unterstreicht auch die Öffnung, die in letzter Zeit stattgefunden hat, im Business, aber auch im persönlichen Bereich. Wir freuen uns, dass wir mit Saudi-Arabien sehr gute und intensive Beziehungen aufbauen konnten, und wir werden dies verstärken. Das Doppelbesteuerungsabkommen wird am 1. April oder ist am 1. April in Kraft getreten. Bisher hatten wir mit Saudi-Arabien lediglich ein Abkommen über die Befreiung von Steuern auf dem Gebiet der internationalen Luftfahrt. Das stammt aus dem Jahr 1999. Seit 2009 besteht ein Freihandelsabkommen der EFTA mit Saudi-Arabien. Also auch hier haben wir die Beziehungen verbessert und verstärkt. 2010 haben wir dann begonnen, dieses Doppelbesteuerungsabkommen auszuhandeln, haben es 2016 abgeschlossen. Es ging durch unser Parlament, wurde entsprechend unterstützt, und damit ist die Voraussetzung gegeben, um die Geschäftstätigkeit weiter auszubauen mit dem Titel der Rechtssicherheit, das dieses Doppelbesteuerungsabkommen bietet. Es muss ein weiter wichtiger Schritt sein, ein Schritt, die Beziehungen zu intensivieren, weil beide Partner, sowohl Saudi-Arabien wie die Schweiz, haben Interesse daran, die wirtschaftlichen Beziehungen auszubauen, und das soll begleitet werden auch von einem offenen Dialog mit unseren Partnern in Saudi-Arabien, sei das nun auf Stufe der Staaten, sei das auf Stufe der Unternehmen. Ich wünsche uns allen und Ihnen viel Glück und viel Erfolg und eine intensive Beziehung zu Saudi-Arabien. Grundlage soll dieses Doppelbesteuerungsabkommen sein. Besten Dank.
A special thanks to our Finance Minister Ueli Maurer for his contribution to our webinar. Let me now introduce our first guest speaker, Stefano Bernasconi. Stefano is a policy advisor at the State Secretariat for International Finance at the Federal Department of Finance since 2017. He works in the section Bilateral Tax Issues and Double Taxation Treaties, where he negotiates mutual agreement, procedure, and tax treaty. Stefano, the floor is yours.
Thank you, George, and good afternoon also from my side. In the next 10 minutes, I will try to give you a very short introduction to the topic of tax treaties. This, of course, with a closer look to the new convention between the Kingdom of Saudi Arabia and Switzerland. First, the most important thing and the reason of today's webinar. After four rounds of negotiation and the completion of the internal procedures for the signature and the ratification in both states, finally, and as mentioned by Minister Maurer, on 1st of April 2021, the convention between Switzerland and Saudi Arabia for the avoidance of double taxation with respect to taxes on income and on capital entered into force. However, and I think this is an important point, according to the convention, according to Article 29 of the convention, the provision of the tax treaty will apply from 1st of January 2022. So we have to wait another 6 months until the convention is fully applicable. However, I think this is a very welcome development as Saudi Arabia and Switzerland are or as Saudi Arabia is an important trade and investment partner for Switzerland. So, what is a double taxation convention? A double taxation convention is an international agreement concluded between two or sometimes more states and governed by international law. Without a double taxation convention, both states would just tax their taxpayers according to their domestic law. And this, as we all know, could lead to double taxation. For example, when both states see a taxpayer as their resident and tax his worldwide income. So in cross-border trade, such a double taxation can make transactions financially impossible or at least considerably more expensive. Without a double taxation convention, companies will alternatively have to structure their transactions via third countries or at least via third countries with existing treaties, which in turn adds additional costs and is not an efficient way to do business. So, in short, the main objective of a double taxation convention is to facilitate cross-border trade and investment by eliminating the tax impediments of these cross-border flows. I can say that many studies have proven in the past that the double taxation convention supports the economic ties between contracting states, and not at least because for the taxpayer, such a treaty adds legal certainty, and this is of course important for doing business. So coming from this relatively broad objective to the bit more specific purposes of a tax treaty, we can say there are three main purposes. First, of course, and still most importantly, the avoidance of double taxation. When we speak of double taxation in connection with tax treaties, we mean generally the juridical double taxation. This is when the same income or the same capital of one taxpayer is taxed in two or probably more countries. Um, another sort of double taxation is the economic double taxation. This is when income or capital is taxed more than once, but not with the same taxpayer. These situations are, and this I have to mention, just partially addressed from the double taxation convention. So the second purpose of the convention is the prevention of tax evasion and avoidance. Tax evasion and tax avoidance can lead to double non-taxation. This is the opposite of double taxation. But also double non-taxation creates barriers to efficient trade through unequal financial burdens. And that is why, especially in recent years and in newer tax treaties, the focus and one purpose lies also on the prevention of double non-taxation. In our treaty, this topic is addressed in the title directly, also in the preamble, and most importantly, in Article 28, where you find a general anti-abuse provision um, that addresses tax avoidance and tax evasion. The last purpose of a tax treaty, or the third purpose of a tax treaty, is also to facilitate administrative cooperation. In our case, this is, of course, the exchange of information between the two countries. However, here I can add as a side note that both countries have already signed the Convention on Mutual Administrative Assistance in Tax Matters, and that convention enables the country to exchange information. Also, important to know that already since 2018, both countries exchange or have the automatic exchange of information on financial accounts. So for these um, exchange of information, the treaty will not make a big difference. Um, Coming to the next slide, what is the effect of a double taxation convention with regard to the avoidance of double taxation? To start with, I can say that you will, at least for the moment, not find a provision in a double taxation convention that says, for example, employment income is taxed in Switzerland with a rate of 20%. This is not how double tax convention work, because also with a tax treaty, taxes are always imposed by domestic law. So states tax on the basis of their own law their taxpayers. But what the treaty does is that it limits the contracting state in the application of their internal law. So to say, the treaty sets boundaries on the domestic taxation. Um, we say this is a negative effect of the double taxation convention. It does not impose taxes, but it limits the levy of taxes. So before applying the provisions of a tax treaty, I think it's appropriate to always determine whether the amount in question is actually subject to domestic tax. I can also give a very short example. Uh, if under the provision of a treaty between country A and country B, income from dividend of one country to a resident of the other country is subject to a maximum tax rate of 15%. But under the domestic law of country A, no tax is levied at all. The treaty does not give the country A the right to impose 15% withholding tax on dividends. So if the domestic law says no tax, then also with the treaty it remains 0%. On the next two slides, I want to give you a very short overview of the structure of the tax treaty between Switzerland and Saudi Arabia. There are around 3,000 tax treaties in the world at the moment, and most of them are structured in a similar or in the same way. Also, the two well-known model conventions of the UN and of the OECD are structured in this way. This even though the content of the articles is not the same, but at least the structure is the same. So this helps to read and understand the different tax treaty. So also our new treaty starts with the scope of the convention, the persons covered, the taxes covered, then the definitions. Here, especially the definition of the resident and the definition of the permanent establishment. And then, let's say that the heart of the tax treaty are the distributive rules. They start in Article 6 up to 23. I can show you here all these distributive rules, and they, in the end, they decide in what situation which country can tax a certain type of income, and if the country can tax the whole amount or maybe just a limited amount. So this is really the core of the tax treaty, and important for the application. After these distributive rules, we have the article of the elimination of double taxation. So this article decides how a country has to avoid the double taxation. And in the end, we have some special provisions, the mutual agreement procedure, and the exchange of information. And as already said in Article 28, also this general anti-abuse rule. As with many treaties, we have also a protocol, and there also sometimes a bit more specific, but very important provision that can be found in the protocol. Natalie Dini will present now in a more detailed manner the different articles of the treaty, and I will give the floor to her, and I thank you for your attention. Goodbye.
Thank you, Stefano, for your contribution. We will see you back during our Q&A session. Let me now introduce Natalie Dini. Natalie is a partner at Taxpartner AG in Zurich with a vast experience working as a tax advisor, in particular for international businesses and also for individuals exposed to international tax matters. In addition, she is a lecturer at postgraduate studies in tax law. Natalie holds an LLM in tax law. So, Natalie, it's your turn now. Thank you.
Thank you, George. I am happy to take over here and address some topics from a Swiss perspective. I have a short overview for you of what we are going to touch upon. So there will be some selected articles from the Double Tax Convention that I would like to discuss in a little bit more detail. And maybe first, and that's important to know, which taxes are actually covered by the convention between Switzerland and Saudi Arabia. So in Saudi Arabia, the convention covers the zakat and the income tax, including natural gas investment tax. From a Swiss perspective, the convention covers all taxes on income and capital for federal, cantonal, and communal level, because as you might know, in Switzerland, we levy the tax on 3 levels, and all of these are covered by the convention. I thought it would make sense to look at the residence article. This is an important part of any double tax convention because it addresses the question, where is a person actually considered resident and therefore subject to an unlimited tax liability? The Article 4 about the residence in the double tax convention follows the model convention of the OECD. And what we do here is, if an individual is considered resident in both states, we follow what we call the tiebreaker rule. And in the first step, we try to analyze, is there a permanent home available in both states or in any of the states? And if we have a situation where an individual has a permanent home available in both states, we move on to the question of the center of vital interests. So here we try to find out to which state the person has the stronger personal and economic relations. So personal relations would be family ties, economic relations, for example, investments and employment. This is also usually the stage of where we end up with a clear answer, because it's rather rare that an individual will have the center of vital interests in both states, or actually very similar ties to both states. Nevertheless, should this be the case and we're not able to determine the residence based on the center of vital interests, we move on to analyze an individual's habitual abode. This actually ends up counting days. So we try to find out, where does a person spend more time? If a person ends up spending the same amount of time in both states, we then analyze the person's nationality. And if the individual is a national of both contracting states or of neither of them, the solution will depend on a mutual agreement procedure where the both states find a solution together. If we're not talking about the residence of an individual, but actually the residence of a company, we will need to determine where the place of effective management lies. So not the residence or of the legal seat, so where a company was legally incorporated is decisive, but actually where it is effectively managed and where the daily business of the company is run. I would like to continue with the taxation of immovable property, actually real estate, and look at this from a Swiss perspective. I have 2 scenarios here. We have a person resident in Switzerland with real estate property in Saudi Arabia. In this case, there will be a tax exemption from a Swiss perspective. So Switzerland will not levy any tax in relation to the foreign property. In the other scenario, where the individual is actually a resident of Saudi Arabia and holds real estate in Switzerland, Switzerland will only tax the real estate and nothing else. So the tax is limited to income and assets in direct connection with the property in Switzerland. A very important article is Article 10 about dividend taxation. And again, I have 2 scenarios here. In the first scenario, we have an individual who invests in a Swiss company. So the individual is a resident of Saudi Arabia and holds a participation in a Swiss entity, and the Swiss entity will distribute a dividend to the shareholder. Based on Swiss domestic law, dividends are subject to a withholding tax of 35%, which is very high. Now, the treaty will limit this tax to 15%. In practice, this means that the individual may file a refund claim with the Swiss authorities for 20%, and the 15% Swiss tax will remain. The second scenario that you see on this slide is that the shareholder is no longer an individual, but the shareholder is actually a company, a corporation, and the dividend is paid from the Swiss subsidiary to its Saudi Arabia-based parent company. In this case, the treaty or the double tax convention limits the Swiss withholding tax to only 5%. It is required that the shareholding is at least 10%. So the recipient company must have a participation of at least 10%. In this case, we can either file a refund claim for 30%, or we can ask for direct relief at source, which means that 95% of the dividend are paid out and only 5% are withheld. Article 11 touches upon income from debt claims, or actually just interest. Here again, I have assumed that we have a Swiss entity that's paying interest to either an individual shareholder or a corporation. In the first case, where the recipient of the interest is an individual, the double tax convention limits the tax to 5%. In practice, based on domestic law, this will be, in most cases, 0%. And the second scenario, where the recipient of the interest is a corporation, then already based on the treaty, Switzerland has no right to withhold any tax. So no right to withhold tax in case of loans between two companies. Article 12 is about royalties. In this case, we have a Swiss entity paying a royalty to a Saudi recipient entity. Based on the treaty, we have two taxes here, or two different scenarios of tax. We have a 5% or a 7% withholding tax that's granted to Switzerland based on the treaty. Now, here again, we have to go into domestic law to actually find out what tax is. So even though the double tax convention would allow Switzerland to withhold these 5 or 7% respectively, based on domestic Swiss law, there will be no withholding tax. Switzerland does not have a withholding tax on royalty payments. In this next slide, I would like to show you the difference between employment income on the one hand and directors' fees on the other hand, and why it is important to make a distinction between those two. So in both cases, we have a Swiss entity that employs a Saudi resident individual. If we are talking about employment income, the right to levy an income tax will usually be where the employment is physically exercised. So we need to know, where does this person exercise the employment, and that's usually where the tax is due. Now, if we're talking about directors' fees, in that case, the right to tax the income from the directors' fees solely lies with the country where the company is. So in our example right here that you can see on the slide, only Switzerland will be allowed to tax the director's fees, no matter where the function of the director is actually executed. Now, we've seen a couple of examples of different types of income: dividend, interest, royalty, real estate, etc., employment income. And we've seen how the double tax convention gives each state the right to levy a tax or not. But now we need to also know, how is a double taxation effectively eliminated? If a person is considered to be resident in Saudi Arabia, what happens is that there's a deduction of taxes paid in Switzerland. However, this does not touch the zakat collection, which still applies. And from a Swiss perspective, what we do is that we usually exempt the income. So if the double tax convention tells us that Saudi Arabia has the right to tax, Switzerland will exempt this income from its taxation. An exception applies to dividend income, interest, and royalties. In these cases, Switzerland will not exempt the income, but instead, Switzerland will grant a credit of any tax paid in Saudi Arabia against the Swiss tax. Article 25 covers what we call the mutual agreement procedure that I already mentioned when we were talking about the residence article. The mutual agreement procedure is a procedure between the competent authorities of the two states. So in case a person fears that there could be a double taxation, or if there actually is a double taxation, and we have a situation with a tax dispute or difficulties with the interpretation of a certain article of the Double Tax Convention, there is the possibility to initiate a mutual agreement procedure whereby the two contracting states will try to find a solution to resolve this tax dispute. The deadline to file such a request is usually within 3 years from the first notification of the action that results in a double taxation. Always of interest is the exchange of information. It's important that we distinguish between the automatic exchange of information and the exchange of information that's covered in the convention in Article 26, because this exchange of information is only upon request of a contracting state. So if, for example, Switzerland feels, or the Swiss authorities feel, that they are unable to enforce the Swiss domestic laws or to carry out the provisions of the Double Tax Convention, they will file a request with Saudi Arabia to receive additional information on the taxpayer. Now here it's important to mention that only information that is foreseeably relevant may be exchanged. It's not allowed to initiate fishing expeditions and ask for information that will not be relevant. So I've already reached the end of my short presentation, and I hope I've given you a little bit of an overview of what it covers. And now I'm very happy to hand over to my colleague, Peter. Thank you very much.
1.
Natalie, thanks. Good afternoon to everyone. So today we'll try and put a Saudi Arabian tax perspective onto some of the key aspects of the new treaty. So in particular, the topics that we'll be discussing today are set out here. So what is a PE under the tax treaty? How to calculate the profits attributable to a PE? What capital gains are subject to Saudi Arabian tax? A very high-level overview of the Saudi Arabian withholding tax rules and how they're modified by the tax treaty, and the procedures for claiming tax treaty benefits. So next we'll move to what is a PE. So on this slide, we've set out what gives rise to a permanent establishment. The 5 scenarios will look very familiar to those who work with tax treaties, but I'll put a Saudi Arabian flavour on them. A place of business must be fixed in terms of location and time, generally well understood. It's further understood that usually the time period required is 6 months or more. There's guidance in Saudi Arabia in the form of frequently asked questions that provides the existence for 3 months is generally insufficient. So whilst I consider the minimum time period should be 6 months, there is a risk that a PE could be asserted between 3 and 6 months by the tax authorities. Under the Saudi Arabian domestic tax law, there's no time threshold for building sites, etc. So it's often said that 1 day can result in a PE, and this is the reason why. The tax treaty should be welcomed here as it provides a 6-month threshold. Next listed is when a service PE arises, and we'll discuss this on the next slide. Lastly, there's the dependent agent PE concept. It's important to note in this regard that concluding contracts is more than merely signing them. Arguably, it extends to negotiating the terms of the contract. So it's not just rubber stamping. So now we'll move to look at the service PE concept. So here I've noted the virtual services PE approach, and this is one of the more controversial Saudi Arabian tax approaches. Generally, it's accepted that for there to be a service PE, employees or other persons must be physically present in a country for the threshold number of days, which generally is 183 days or more. However, Saudi Arabia considers that physical presence in Saudi Arabia is not required. Accordingly, the provision of services for 183 days for the same or a connected project can result in a PE. The virtual services approach is applied, though, generally only if exemption from withholding tax on services is claimed under a tax treaty. So if you pay the withholding tax and you don't claim it back, then it's not. There should be a very low practical risk of assertion of a virtual services PE. So next we'll look at when a PE does not arise. So what's excluded? So the exclusions in the tax treaty between Saudi Arabia and Switzerland are generally consistent with those in other treaties. So there's really no surprises here. So we can move to the next topic of what profits are attributable to a PE. So I think it's important to set out how to determine profits of a PE under Saudi Arabian domestic law and then contrast that with the treaty. So under Saudi Arabian domestic law, the critical thing to note is that there is an express force of attraction rule. So included in the income of a PE is income from sales in Saudi Arabia of goods or services, of goods of the same or similar kind as those sold through a PE, and income from rendering services or carrying out another activity in Saudi Arabia of the same or similar nature as an activity performed through the PE. And this is something that that many entrants to Saudi Arabia aren't aware of, and it was potentially an issue for Swiss prior to the treaty. Would have been an issue for Swiss entities with branches in Saudi Arabia, but remains. But the treaty will now change that. Will now change that. So now let's look at how to determine profits of a PE under the tax treaty. So the first thing to note in relation to the tax treaty is there's no force of attraction rule. The next thing to note is that there's a modified full separate entity approach. only the actual cost to an entity related to the head office charges noted on this slide are deductible in determining the profits of a PE. There's a similar rule for income in respect of charges from a PE to head office. There's no margin either on costs in or charges out from the PE. So almost it's effectively a source rule. Where there are significant charges between a PE and a head office or other offices of the entity that has the PE, the above modifications can result in significant differences from what would occur under a full separate entity approach. If you want to achieve a full separate entity outcome for a branch, then it's important to ensure that the branch transacts with sister entities and not with its head office or other parts of that entity. So there's one last point that I want to make in relation to profits of a PE. So we'll move to the next slide now. So this is Article 7.6 of the tax treaty. Now, I'll confess, I need to look further into this clause to understand it more fully. However, my initial thoughts are that it leaves the proverbial door open for Saudi Arabia making assessments of a PE based on its gross revenue and a deemed profit percentage. So, you know, commonly known as deemed profits assessment. And in this, all Saudi Arabia have to do is take the gross revenue of the PE and apply a profit rate to it, and then subject the resultant deemed profit to tax at 20%, and then also impose withholding tax on the deemed after-tax profits. There is the important caveat here in the clause, and that's that the result shall be in accordance contained with the principles contained in this article. So presumably there must be a correlation between the actual profits plus the actual profits plus the deemed profits, but remains to be seen how that plays out in practice. So we'll move now to look at what capital gains a Swiss resident will be subject to tax on in Saudi Arabia. So set out on this slide are the gains that will be subject to Saudi Arabian tax. The cases are generally consistent with what is covered in standard tax treaties. Relevantly, shares in Saudi Arabian listed companies are not taxed. This is consistent with Saudi Arabian domestic law. And shares in non-listed Saudi companies are only taxed if the holding requirement is met. So they've introduced effectively a participation rule that there must be at least a 10% direct or indirect holding during the preceding 12 months. There is some good news, and that's that the tax applied on such gains is going to be limited to 15%, which is 5% less than the standard rate of tax in Saudi Arabia. So now we'll progress to withholding tax. So set out on this slide is a very high-level overview of the withholding tax regime in Saudi Arabia. It's important to note that it's comprehensive. So it's not limited, it extends beyond dividends, interest and royalties. And also that it distinguishes between payments between related parties and non-related parties. In particular with respect to technical consulting services. If they're to a related party, it's 15%. If they're to a non-related party, it's 5%. There is an important exclusion, and that's that this only applies to B2B transactions. B2C transactions should not be subject to withholding tax. And only payments from sources in Saudi Arabia are subject to withholding tax. So on the next, we'll move to the next slide, and here we'll look at how the tax treaty modifies the withholding tax. So you'll see here that withholding tax on dividends and interest is not limited by the tax treaty. It will remain at 5% in all cases. However, there's some reduction for royalties. So if the royalties relate to the use of industrial, commercial, or scientific equipment, then the royalty will be reduced from 15 to 5%. Alternatively, in all other cases, the royalties will be reduced by 8% down to 7%. Now, it is important to note that if an exemption under the tax treaty from withholding tax is claimed, then Saudi Arabia may assert a virtual services permanent establishment. So if you claim exemption from withholding tax, then you may get a deemed assessment. Then you may get a deemed assessment and be subject to tax on that. And that was mentioned in the earlier bit on permanent establishment. Now, for those who wish to claim tax treaty benefits, we've got a very a summarised form on the next page of what the process is. So there's two approaches. Tax treaty benefits can be claimed either upfront or via a refund. So that's basically pay now and claim back later. The forms required for either approach are listed. So common to both is a tax residency certificate and a form Q7B. These need to be certified and they're tested by the local Saudi embassies. And currently, this can take 2 to 3 weeks. And in relation to the upfront approach, it's important that the payer needs to make a form Q7C undertaking, which basically means that they accept liability in the event that the treaty benefits are denied and that tax is required to be paid. So it's very common that unrelated parties will be reluctant to provide a Q7C form. So that's something to bear in mind if you're an inbound or providing services. If you're providing services from outside Saudi Arabia to customers inside Saudi, that you may want to have an express clause when you're dealing with them, either gross up or in relation to form Q7C. So that concludes the discussion. Thanks for the opportunity to discuss the Saudi Arabian implications of the new tax treaty, and I'll hand back to George.
Thank you very much, Peter, for your contribution. Now we would like to move forward to the Q&A session. Unfortunately, Peter had to leave, so we will go in the Q&A with Stefano and Natalie. Can we start with you, Natalie, with the first question? Regarding the determination of an individual residence, how does Switzerland define the term permanent home? Example, if a person resides in a same hotel repeatedly, could this be a permanent home?
Thank you for the question. It's an interesting one because we know of other countries that might be a bit more aggressive here, like for example, Germany, where already staying at the same hotel can lead to the consideration of a permanent home. This based on decisions by the Swiss Supreme Court should not be the case in Switzerland. So staying at a hotel would not be enough. We would actually need a real home to fulfill this criteria of a permanent home.
Thank you. Stefano, some tax treaty contains an arbitration clause. Is the DTC between Switzerland and Saudi Arabia arbitration is only mentioned in paragraph 9 of the protocol of the treaty? Why?
Yes, it is true that our treaty contained no arbitration clause, and treaties are always the result of negotiations, and therefore some articles get into the treaty, others not. And maybe arbitration has to be seen in a wider context, in a context of the mutual agreement procedure of Article 25. Natalie was already talking about this procedure. Here, a taxpayer can ask for a mutual agreement procedure in case he's taxed in a contracting state not in accordance with the convention. Then the competent authorities they try or they endeavor to resolve the double taxation, and this wording hints that they endeavor, but it's not 100% sure that in a MAP, in a mutual agreement procedure, there is in the end a solution. And so this is when arbitration and the case would be handed over to the arbitration panel. But I work for the competent authorities, and we do a lot of mutual agreement procedures with other countries. And I have to say the cases going to arbitration are very, very rare. So at least a mutual agreement provision is we have it in the treaty, and it's very important. And for the moment, Switzerland's treaty policy is to include the arbitration clause. Other countries, here Saudi Arabia, they're not yet in favor of such a clause because it's relatively new. And maybe some more experience has to be made. But this is the start of your question. We have at least in the protocol a provision that says that both countries enter into discussion as soon as Saudi Arabia changes its policy in that area. And so in case that would be in the future, then we will not lose time, and we can hopefully include such a provision.
Thank you, Stefano. Another question to you, Natalie, regarding dividend taxation. In case dividends are paid from a Swiss subsidiary to a Saudi parent company, the Swiss withholding tax can be reduced from its source from 35 to 5%. How simple is this in practice to receive such a relief at source, and what is the procedure?
Thank you. Yes, if a Swiss entity pays out a dividend, we, based on Swiss domestic law, withhold a tax of 35%, which is quite high. And of course, any company distributing a dividend to a parent company is interested in receiving a relief at source, meaning that they don't have to first pay the entire withholding tax and then file a reclaim. So what is done is that you have to use the official form and file it with the Swiss Federal Tax Administration. This form will continue information on the Swiss entity that's distributing the dividend, as well as on the Saudi recipient entity and the parent company receiving the dividend. And with this form, it will be necessary to confirm that the Saudi company receiving the dividend is the real beneficial owner of this dividend, etc. When this request is done or filed with the Swiss Federal Tax Administration for the first time, the tax administration will ask for additional documents such as a full group chart. They will want to test if there's sufficient substance in Saudi Arabia. So they will want to know about the infrastructure, employees, the amount of equity, etc. So they will make sure that we don't have a case of treaty abuse. Once this permission is granted, so once the Swiss Federal Tax Administration have said we are able to have a relief at source, this permission is valid for 3 years and must then be renewed. The procedure to receive such permission, which would allow us to only withhold 5% instead of 35%, this procedure usually takes a few months. So it's always advisable to start the process of filing the request and putting together the necessary documentation well in advance of any dividend payment.
Thank you, Natalie. Maybe one question for Stefano. I have here a question coming from Tariq. How the taxation will be calculated for services exercised in the two countries but executed only in one? I don't know if you can answer that. Maybe it would be a question for Peter. I don't know, Stefano.
So can you read the question again?
Yeah,
Maybe it's a question for Peter.
Yeah, I think it's for service executed in 2 countries, but executed in 1. If a company produces something in 1 country, but for both countries, how will the taxation be calculated for these services?
I think it was what Peter talked about before regarding the attribution of profits, maybe to a permanent establishment, and here the maybe that's the question, if I understand it correctly.
I would
maybe
recommend
Natalie
to Tarik to pass this question to Peter. Unfortunately, Peter could not be with us for the Q&A session. Maybe another question to Natalie. Regarding the exchange of information upon request, according to your experience, do the Swiss authority have a tendency to share information which is requested quite willingly, or they are more reluctant to send information to the requesting states?
Well, I've accompanied many such requests where the contracting party has filed a request with the Swiss Federal Tax Administration to receive additional documents such as tax returns, tax rulings, etc. And it's always very difficult for the Swiss Federal Tax Administration to assess whether this information is foreseeably relevant to the other state. So once such a request is received by the Swiss authorities, they have a tendency not to question the relevance of the request, but they assume that if this request has been made, that obviously the information is required. However, they are willing to only share what's really necessary, meaning that certain pieces of information may be blacked out because they say this is not relevant, and there is a reluctancy to really share full tax returns, etc. So we, as usual, Switzerland, we do our best to comply and to deliver what is requested, but we also make sure that it's sensible. If I hope this answers the question.
Thank you. I'm sorry that a few questions that has been raised should have been answered by Peter. Unfortunately, he's not here, but we will get back to Peter, and you will receive the answer raised directly from Peter. It's time for me to close this webinar. I would like to thank you all for attending our today's session. I would like to address a special thanks to our Ministry of Finance, Bundesrat Ueli Maurer, for his contribution to our event. Of course, to our 3 guest speakers, Natalie, Peter, and Stefano. I would like to also highlight our ambassador André Schaller and her deputy Sonia Isabella for their huge support to our network. To Aaron Johnson, the man behind the webinar. Without him, we will not have been able to be here to you. And last but not least, to Bruno Sifrig for his endless support and contribution to the network. I wish you a nice evening. All the best. Stay safe and goodbye.